In this video, we're going to extend our discussion to the dividend growth model and then ultimately to the multiplier models. So let's start with the dividend model, which starts exactly the same way the free cash flow model started. Ask the exact same questions again. How can you find the present value of an infinite stream of dividends? We know that mathematically that simplifies. So we need to know the dividend today, D0. We need to know the required rate of return on the stock. We can get that from the capital asset pricing model, and some other techniques can help us with the required return as well. And of course, we need to have an understanding of what the growth rate is going to be. That's the one thing that we're going to have to predict. So if dividends are expected to grow at a constant growth rate, then we know that we have this algebraic process where it's the way the time value of money grows, that each year outgrows at a higher and higher exponent, if you will, to find out the dividends in the future. So here we have the required return of the company, right? So we know if a company has a beta of 2, the risk-free rate of return is 7, and the return on the marketplace is 12. Now, I don't know why they pick these numbers. They're exceptionally high. As you know from maybe some other courses, the current risk-free rate of return on a 30-year treasury bond is in the 1.5 to 2.0 range on a good day. In addition, the risk premium for stocks, right? That's the risk premium, the return on the stock market minus the risk-free rate. Right now is probably closer to 10%. But with such a high risk-free rate of return, and then implying a 12% return on the stock market, they have a pretty low risk premium for investing in stocks. So currently, these numbers really don't make sense. So don't take this as an example of what you might see in real life. However, if those are the numbers that we have, we can incorporate it into this form. So on the stock valuation dividend model worksheet, we can plug these numbers in. There's a place to find R sub S. So in this case, this stock would have a rate of return of 13%. So on that same worksheet, then, we can incorporate or add the rest of the data that we know. 2% is the most recent dividend, D sub 0. We have said that we think that the growth rate is going to be 6%. So when you put those numbers into our worksheet here, we find out that this stock has a value of $30.29. So we can also say, well, what do you think the price will be a year from now? Well, you can take the D sub 1, right? Or D sub 2 is D sub 1. We just calculated that a second ago up here, right? So D sub 1 is $2.12. Multiply it by 1 plus the growth rate. So next year, we expect the dividend to be 2.2472. Again, divide that by the difference between the required return and the growth rate. Next year, we expect the stock price to be $32.10. So this year was $30.29. In the next year, we expect it to grow by a little bit over close to $2. So again, So now you can see that we have a way that you can predict prices moving forward. So what other information is available? Maybe we want to calculate the dividend yield, right? So if you think the return on a stock is equal to the dividend yield plus the growth rate, right? This is the capital gains growth rate. So the dividend yield, you take D1 divided by the value that we just assumed, 7%. P1, this is the capital gains yield, the change in value that we expect in the next year, 6%. So 7 plus 6 is 13%. And in this case, that is what our required cost of capital is. Our required return is this 13%. So again, this is another way that we can calculate the required return. If we have a forecast of dividends, we can work our way backwards, if you will. So again, for year one, this is the information we know. We expect a total return of 13%. The required return, we said, is 13%. And we think for this stock, the constant growth of stock is the capital gains yield, which again, 6%. So again, we can utilize some basic information about dividends, required returns. The heavy lifting is all about calculating the growth rate. What do you think that growth rate will be for the long term? This is a little bit maybe beyond what this course is really all about. However, we may talk about this when we get to some capital budgeting issues in some later videos. Again, for the non-stock growth models, we can still incorporate the same basic ideas as we did with the free cash models. So we can't use the constant growth models if we expect the growth to change. So how can we estimate this? So we can put in here, again, this is in our supernormal growth stock worksheet. You put in the current dividend, the required return, and the end of the variable growth period. Put in your growths that you expect. And again, it will calculate the dividends, the future price, then it will calculate the present values and give you a sum. So in this case, it's 42.148. Now there's also in this supernormal growth stock worksheet a simplified version of this, where essentially we say the growth rate for the first 3 years is one number, and then it changes to another. That's a very simplified model of this non-constant growth rate. But I mean, it works, it's functional, it tells us a little bit about what we should expect to happen with value changes. So now let's switch gears and talk about what they refer to as multipliers. The most excuse me, the most common multiplier is the PE ratio. So again, the idea here is we need to know what this PE ratio is. So let's think about the formula. PE ratio equals the market price divided by earnings per share. So now if we can look at these, let's do a little algebra. So if you do a little algebra and solve for market, the PE ratio multiplied by earnings per share equals the market price. Right? So, I mean, the algebra is right. We know that that works. So how can we then try to determine value, right? We need to have some predictions. We need to predict what do we think earnings per share will be 1 year from today. What do we think the PE ratio will be 1 year from today? Now, the PE ratio, we can use a variety of things for this. However, it's pretty difficult to predict with any real accuracy because it's dependent on investors' expectations. And should they change during the year, our prediction will change. So we can look at some averages, or we can assume some things about what's going to happen to the company, good or bad, and maybe make some changes. Earnings per share, though, is something that we absolutely can predict. So again, if we predict earnings per share, this is earnings per share. I'm going to change this to subscript 1, where T equals 1. PE ratio, well, let's just say it's the same, right? So if the earnings per share, let me go and put some notes. So let's say the PE ratio was 20 and earnings per share were 3. That means that the stock price has got to be $60. We don't want to know the current price. We want to know the future price. So if we say the PE ratio will stay the same, but now earnings per share will go to $4, that means the stock price goes to $80. So again, we're predicting a $20 increase in value when earnings per share changes. So again, it's a pretty simple model, and there are a lot of other kinds of models that you can utilize as well. Price to sales, there's a lot of them. One of the ones that's used fairly frequently is something called the entity multiples. And the entity value of the stock is the market value of the stock plus the value of the debt. Right? So it's just the number of shares of stock multiplied by price, and then you add the value of that. That's called entity value. Now we need to have something to make comparisons to. So you pick a measure like EBITDA, sales, customers, eyeballs, right? Anything that's related to the company, and you want to calculate the average entity value for a sample of comparable companies. So maybe you want value divided by EBITDA, or value divided by customers. Again, now what we have to do is forecast customers to ultimately increase or calculate the value of the company. So you multiply the firm's sales by value divided by sales multiplier, or multiply the firm's customers by the value divided by customers ratio, and ultimately the result is the firm's total value, right? So value, we know value equals the value of the stock plus the value of the debt. So now if you just subtract debt from value, you find the value of equity of the company. Divide it by number of shares, and now you have a price per share. So it's a pretty simple process. Like I said, there are lots of variables that this works with. It's kind of hard sometimes to find these comparable firms, right? For instance, if you look at some, especially companies that are dominated by one big company or a couple of big companies, they really skew the number towards them. So the average really isn't reflective of a true average, if you will. So again, we might want to look at a range of possibilities, right? Maybe instead of saying the average is 20, but really could be as low as 20, could be as high as 50, right? How do you know where your company will be? And you really don't know where it will be. But if you use a range, so maybe you use the number 10, you use the number of 30, you use the number of 50, you would ultimately have a range of prices that you would think the company is going to be within that range. And of course, if all of those are above the current market value, it implies there's some capital growth that's potentially can be reaped from investing in those companies. So let's compare the free cash flow model and the dividend growth model quickly, right? You can apply the free cash flow model in a lot more situations. Privately held companies, divisions, companies that don't pay dividends. But they require you to forecast financial statements. it's a little bit more takes more effort than trying to forecast dividends. But it also, because of the value drivers, it can be a much more beneficial tool for managers in understanding how their operations are actually performing. Just the last thing before we leave is you can utilize the dividend growth model for preferred stocks just like you did with stocks. Preferred stocks are referred to as a hybrid security. They're similar to bonds. They have a fixed payout, a dividend, and it has to be paid before the common stock. So in the end, it is less risky than the common stock. But unlike the bonds, companies don't have to pay the dividends if they don't want to. So, there's some aspects that are less risky, and then there are some aspects that are more risky. However, in general, I would say that it's rare that a company would ever default, not that it's really a default, or not make payments on preferred shares, since they can't make common shares dividends until those numbers are made up. But again, we can plug this into our stock valuation model. Note here that the difference here is the growth rate is going to be 0. So if it pays $210 a year in dividends and the required return on preferred stock 7%, this stock roughly sells for around $30. So that's the end of this video. I look forward to seeing you in future videos.